Chapter 4 reviews adjusting journal entries. When we do adjusting journal entries, we start with the trial balance. In this example, we look at a trial balance from the Pioneer Advertising Company. Pioneer Advertising bought $2,500 of supplies at the beginning of October. When the company bought supplies, they debited supplies and credited cash. At the end of the month, they need to record the ending balance in the supplies account. A physical count of the inventory shows there's only $1,000 worth of supplies on hand. If the beginning balance is $2,500 and the ending balance is $1,000, then the company used $1,500 worth of supplies. In order to record this, we debit the supplies expense for $1,500 and credit the supplies account. Every time we do an adjusting journal entry, it affects one income statement account and one balance sheet account. At the beginning of October, the company purchases a 1-year fire insurance policy. When the company does this, the company debits prepaid insurance for $600 and credits cash for $600. At the end of October, you need to record 1 month of insurance that has been used up. To do this, you take $600 divided by 12 and get 50. The journal entry then is a debit to insurance expense for $50 and a credit to prepaid insurance. Insurance expense is found on the income statement. Prepaid insurance is on the balance sheet. Again, every journal entry that is an adjusting journal entry affects one income statement account and one balance sheet account. At the beginning of the month, Pioneer pays for 1 year of rent. When the company prepays the rent, we debit the prepaid rent account for $6,000 and credit cash for $6,000. After 1 month, we need to show the portion of the prepaid rent that has been used up. To do this, we take $6,000 divided by 12 and get $500 per month. The journal entry is a debit to rent expense for $500 and a credit to prepaid rent. Rent expense is increasing, so we debit the expense. Prepaid rent, an asset, is decreasing, so we credit prepaid rent. At the beginning of the month, a customer paid for services that were not yet provided. The company received cash of $1,200, so we debit cash. The credit goes to unearned revenue. Unearned revenue is a liability account. It's a liability because if the company does not perform the service, then the company needs to give the money back. To increase a liability account, we credit the unearned revenue. At the end of the month, we show that the company has performed $400 worth of services. Therefore, we need to reduce that liability account unearned revenue. To reduce the liability, we debit unearned revenue for $400 and we credit the service revenue for $400. We have now performed a service and need to record the revenue. At the end of the month, if you have services you performed that you have not yet billed, you need to send invoices to your customers. When we do this, we need to record that the customer owes us money and record that the service was performed. To do this, we debit accounts receivable of $200 and we credit service revenue for $200. Our accounts receivable is increasing. To increase it, we do a debit. Our service revenue is increasing. To increase revenue, we do a credit. If you have some type of note payable, you will have interest expense associated with it. If the interest expense has been incurred but not yet paid, you need to make an adjusting journal entry to record the expense. In order to record the interest expense, we debit interest expense for $50. We promise to pay the interest later, so we credit interest payable. Interest expense is on the income statement. Interest payable is on the balance sheet. Again, every adjusting entry affects one income statement account, one balance sheet account. At the end of the month, if your employees have worked but you have not yet paid them, you need to record the expense. To do this, we debit our salaries expense for $1,200 and we credit our salaries payable for $1,200. Our expenses are increasing. To increase an expense, we do a debit. Our liabilities are increasing. To increase our liabilities, we do a credit. When a company receives a bill at the end of the month but doesn't pay it until the following month, the expense needs to be recorded. In this example, we receive a telephone bill for $150. Therefore, we need to debit our telephone expense for $150. We promise we'll pay it later, so we need to credit accounts payable. Telephone expense is increasing. To increase, we do a debit. Accounts payable is increasing. To increase, we do a credit. In this example, we receive a utility bill that we will pay next month. We need to record the expense in October, so we debit the utilities expense for $250 and credit our accounts payable for $250. Utilities expense is on the income statement. It increases with a debit. Accounts payable is on the balance sheet. It increases with a credit. When you have property, plant, and equipment, that equipment or property is used up during the period. When we use it up, we need to record depreciation expense. In this example, we have some office equipment. 1 month of depreciation is $40. Our journal entry is a debit to depreciation expense and a credit to accumulated depreciation. Accumulated depreciation is a contra asset account. It has a normal credit balance. To increase accumulated depreciation, you will always do a credit. As a review, at the end of the month, we do adjusting journal entries. The purpose of the entries are to measure income, update the balance sheet, and each adjusting entry affects one income statement account, so either a revenue or expense, and one balance sheet account, either an asset or a liability.